Hi everybody, my name is Randall Morrow with RESNN Investments, and today we're going to talk about whether real estate is a passive investment. And I'm going to be controversial here and just start off the video saying real estate is not passive. I'm going to get skewered out there, but before you slaughter me, hear me out. You may not agree with me, but at least listen to my points. And let me start by saying that I love real estate. I'm a huge fan. I've owned multiple properties over the years, and I think it's an amazing way to diversify your stock and bond portfolio. And I absolutely love the tax benefits that come along with real estate. There simply is no better tax reducer than investing in real estate. But what is passive investing? Well, it's getting your money to work for you, right? If you can have a regular job and at the same time your money is earning income as well as making you money as well, some would consider that passive investing. And for me, that's one criteria, but there's more to consider. Not only must it earn income for me, it has to pass what I call the sleep factor, which is this investment going to keep me up at night? Am I going to be stressed at any point during the investment cycle? And if so, it's not a passive investment. Even if I'm able to sleep at night, if I'm stressed at all during the day because of the investment, then again, not passive. If it's occupying rent in my head, I know, I got you there. Total dad joke. I'm a dad, so you have to expect it. But seriously though, if it's occupying space in your head while you're going throughout your day, then that's not a passive investment. So for real estate, what kind of stress would be added? Well, you have a lot of dollars at stake in a typical real estate investment. And so financial would be the number one, certainly for me. Even if you have a good tenant, you have stressful situations where that tenant can leave. Or you have a tenant that's not taking care of your property. Also financially is property tax gets increased, your insurance goes up, your mortgage adjusts. And those kinds of expenses you can prepare for or run a stress test before you actually do the investment. But I personally have yet to find a property that has enough margin in it to handle all of those potential worst case scenarios and still provide enough cushion to allow me to sleep at night. And again, I absolutely love real estate. I want to be really clear about that. And it might just be me. Certainly every investment has the ideal investor, and maybe I'm not that person for owning direct real estate. But these are factors that you need to consider for yourself. You have to think of that worst case scenario and know, is it going to keep you up at night? Are you going to stress about that? So what's the solution? There's two other ways to invest in real estate that are considered passive. The first is what's called a REIT, or Real Estate Investment Trust. And these are publicly traded investments. You would purchase them through your brokerage firm. And ultimately, you're investing in a company that invests in real estate. And similar to any other stock, it is passive. You hand them the money, you walk away. It sounds passive to me, and it is. It's like owning any other stock in the stock market. But REITs don't pass my other check boxes of why I want to invest in real estate. The first one is it's volatile. Because it's so easily traded, you can buy today, you can sell tomorrow, it experiences more fluctuations when a stock market correction happens. If you think about what happens during a bear market or a stock market correction, investors get scared and they sell. And they generally, although it's not a good investment decision, they generally sell everything. And so if they own a REIT, regardless of the value of the underlying real estate, they're going to get out of the market. And so you have a situation where you're losing 20% on your money, even though the real estate that the REIT owns hasn't changed in value. The other issue is that REITs provide no special tax treatment. In fact, they're actually worse than investing in a traditional dividend stock. The reason why is that the income that they generate from rent is paid to you as a dividend, but it's a non-qualified dividend. And so it's taxed as ordinary income to you, which is terrible. So although REITs solve the sleep factor, so do other defensive investments. And those you can check out my other videos about, but we're talking about healthcare and utility stocks and consumer staples and traditional dividend stocks. So if owning direct real estate doesn't cut it and REITs doesn't cut it, what else is there? Well, there's something called real estate private equity. And ultimately what that is, it's very similar to a REIT in that you invest in a company, they then take your money, purchase properties, and do all the work for you. And then they earn rent from those properties and they pay that rent to you in the form of quarterly distributions. But what's slightly different is that in a real estate private equity fund, you are a partner in the business. And so you get to enjoy all the tax benefits that come along with a traditional real estate investment. So every quarter you're receiving distributions, income, what I will call dividends, and yet on your tax return, you're showing a loss for that investment. What are the other advantages of a real estate private equity deal? Well, it has a relatively low investment minimum. And I say relatively because it's not cheap. While investing in a REIT, you can invest with just hundreds of dollars. A private equity deal generally has a $50,000 minimum. So big number, but significantly less than if I were to purchase a $3 million property down the street. And what's amazing about that is then I can invest in a lot more deals. So it allows me to diversify my real estate investment significantly. I can invest in multiple deals across multiple states, across multiple different asset classes. And so it gives me much greater peace of mind than if I took all my money and invested in one piece of property. And so for me, it solves the diversification problem. And really, it solves all the issues that I have with passive investing in real estate. So what are the downsides? Well, the deals are a little bit hard to find, which can be solved. But the second is, if you don't have any experience in real estate, it's really hard to evaluate whether one deal is a better investment than a second one. And again, that's similar to direct real estate. There's really no difference there. If you have no experience, you're taking a bigger risk. So in summary, I would urge you to consider real estate as an addition to your overall portfolio. It has incredibly low correlation to the stock market. It's a fantastic way to diversify and lower the volatility when the next bear market comes along. And finally, again, before you skewer me, I want to say, I think all real estate is good, but some are more passive than others, and it really has to do with your own personal preference. So thank you very much for listening. Stay safe out there. Bye-bye.